Hey, what's up? Good morning, everyone. Hope everyone's well. It is Monday, March 6th. Whew, this year's starting to fly. We're in the third month of the year already, and we have some updates for you this week. Naturally, today we're going to be starting off with our um, live in our free Discord. You can check that out at community.tradeproacademy.com. I'm going to jump into there right after this YouTube update. But mainly what I want to talk about today is the shift that we're seeing, and a lot of people talking about this, is the difference between a fundamental and a technical standpoint of what's going on in the overall market, right? Some could say that arguably, realistically, fundamentally, we're in a very poor place, right? Fundamental recession continuing to disturb the markets, where we have a lot of things fundamentally that are not right, right? We have massive layoffs, we have higher rates, continued hikes, we have quantitative tightening, very large balance sheet. We've got job cuts, we've got earnings potentials, we have a lot, right? We have yields that are trickling, and overall, from a fundamental perspective, it seems that we're not yet clear out of the woods. But on a technical perspective, a lot of traders and investors are looking to call bottoms or call this next rally to start. So a lot of people are suggesting that the fundamental aspect has already been priced into the market. That's how the market works, and we are out of the woods necessarily. But we'll see how this kind of wraps up and what really happens here. I'm under the perspective that um, this is an area where it's not a bad idea to be looking to buy dips on the equity perspective, because there is that chance of a 10 to 20% up move realistically based on what is going on, right? A lot of hawkish and bearish news that trickled in over the weekend was pretty much subdued by a Goldman Sachs Apple target upgrade of just shy of $200. So it's a mixed matched perspective, and I'm still bearish on the fundamental perspective, but I think that there is that possibility where the potential of an up move outweighs the potential of the next down leg. So it's something to consider for everyone. Very wild first 2 months in the year. We have non-farm payrolls that are going to come out this week. We have Jerome Powell testifying 2 days in a row this week as well. And January and February, pretty solid months for the overall market, right? And it resumes its upward ascent last week. So investors are now sizing their outlooks as trading begins for the first full week of March that starts today, with several catalysts that are coming in, right? We have Tuesday and Wednesday. Jerome Powell, like I said, is going to be testifying on Capitol Hill for the semi-annual testimony, ahead of the February jobs report that's going to be released on Friday. And don't forget the latest CPI that's going to be published next week, I believe on the 14th. That might be a lie. I'm not sure, but it's going to be, I think on Tuesday, we have CPI pre-market and PPI coming out. We have those inflation data points that are going to be very important to consider as we come into the Fed's March policy meeting, and quarterly rate projection that will come out at the end of the month. So one of the biggest or best gauges of the market health is the benchmark S&P, naturally, and perhaps an even better gauge of some of the internal happenings is the market are the sectors that make up said index. So they adhere to same industry taxonomy, closely followed by the financial community, which was developed by the Standards and Poor and MSCI in 1999. Called the Global Industry Classification Standard, the GICS, and the structure consists of 11 sectors as well as 24 industry groups and 69 industries and 158 sub-industries, blah, blah, blah. But mainly looking at those 11 sectors that categorize the all of the major public companies. So what things have shown is that many of the big trades that were hot in 2022, namely energy, consumer staples, healthcare, have been relegated to the back burner. And it appears that investors are betting that record profits seen in 2022 will be hard to replicate in terms of future growth rates, but the rebound might be in store as this year progresses. So on the other hand, infotech, which makes up about 30% of the S&P, has significantly outperformed on the back of rocketing interest in artificial intelligence and a massive U.S. subsidy that pours into the chip sector, which you've seen tech rally aggressively from the start of the week. I still think Meta and Tesla has formed their lows for the year, and they look still very strong, right? Nvidia might be classified as one of those as well. So far, the S&P is up about 6%, just shy of 6% in 2023 after falling about 20% in 2022. The mark is its worst performance since the financial crisis, and it also gives investors plenty of time to make calls on the rest of the year. So we'll see how this thing shapes up. But like I said, the probability of seeing a 10 to 20% rally compared to a 5 to 10% drop, I think, is still higher at this point. A lot can change naturally, but the sectors, right? If I list them out, communication services up about 12%. These are rough figures I'm giving you. About 12%. Consumer discretionary up about 13. Consumer staples down about 3%. This is all year to date. Energy down about 1% and a bit. Financials up about 5%. Healthcare down about 5%. Industrials up about 5%. Infotech up about 12%. Materials 9ish. Real estate 5ish, and utilities about 6.5. So interesting to note, right? A lot of the sectors that had done well last year that are considered more defensive are kind of getting beat up, other than utilities that we can see right now. In other news, right? New budget, new priorities in terms of China's National People's Congress convened its annual parliamentary gathering over the weekend, setting a GDP growth goal of around 5% for 2023 to mark its lowest target in over 3 decades. So perhaps unsurprisingly, China's defense spending will rise by 7.2%, or nearly $230 billion, which is greater than its economy's growth objective and ahead of its 5.7% increase in general public expenditure. So this figure will be on the radar of lawmakers on Capitol Hill, with U.S. defense spending in focus amid a budget cut talk of debt based on the debt ceiling. And tensions are also continuing to escalate between the two world's largest economies, as the Biden administration reportedly prepares a new program that could prohibit American investment in certain Chinese sectors. So based on that, right, we'll see this week how it shapes up. It's going to be a very, very interesting start to the week. We have factory orders today and investor movement index, so fairly non-event news that's coming out. And in terms of, sorry, I'm just trying to open up some charts here. In terms of what's going on right now in the overall S&P, this is something that I'm going to be talking and trading with you guys in our Discord community at TRADEPROacademy.com. So make sure you go check that out, as I'm going to jump into that very, very soon. But looking at this, what happened on Friday, we had a massive rally that sparked from at the 4,000 level. You had massive stuck shorts, which is what we talked about, and you got that massive rebid that I didn't think it sparked this crazy of a rally, but we broke through a key level at 4,023. That was a pivotal point, because that was the top of a key distribution that had been holding out for the past few weeks. And right now we're above it, and we're actually above and trying to push above into a higher distribution that starts at 4,057-ish. Right? That was a key area, and it could rally all the way up to 4,100, 4,105s as long as we sustain that area. But we need to see a solid breakout. There are some poor highs at 4,077 and the 90s, which can be cleared up because we're fairly close to that price. But right now we're holding the mid to high 40s as a key support. I wanted to see if we can dip a little lower to get some new longs introduced and rebid into this market. That still can happen off the open. But right now, as it stands, we're holding fairly well in this more bullish structure and this bullish frame. It's going to be a little harder to be bearish unless we start breaking realistically for 0.23, but that's more of a medium-term objective. If we start moving back under the 45s, I'd be a little concerned, but you have a few key supports. So with that being said, I'm going to jump into that Discord with our friends and talk a little more about the ideas that I'm setting up here, as well as some of the potential options moves, some correlations to look at, blah, blah, blah. So I'm going to be posting a bunch of stuff there. I hope you guys enjoyed this shorter update. I think we'll have more of an update as the week progresses and we get more news that comes out. So thank you all, and I'll see you guys there. Have a great Monday. Trade lighter today. Let's see if the bulls continue this rally, and we'll go from there. So thank you for watching, and we'll see you guys tomorrow.